Good afternoon, everybody, and welcome to the first edition of the Weekly ThinkTank for 2021. My name is Carl Capolingua, and I'm the analyst over here at ThinkMarkets, and it is a pleasure to be with you as we kick off what will hopefully be a very successful year for us here in Weekly ThinkTank as we review the week that was and look ahead to the week that might be. And we'll do that, of course, after we talk about the ThinkMarkets Difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, no hidden platform or subscription fees. And if you sign up with us or switch to us, certainly before January 31, you get yourself 10 free trades as well. So I reckon that's about 14 fantastic reasons to make sure that your next ASX share trade is with us. The agenda for today is to have a look at some of the key market moves from the key markets from last week. We'll check out the COVID situation, have a look at some of the key macroeconomic data. No broker moves today simply because the brokers have been very quiet over the Christmas New Year period. I don't have really fewer than a handful. I can count them on one hand, the number of brokers that actually updated companies over that time. But we certainly will have a look at some value insights for the ASX market, and then some technical insights as well, and then we'll look to the calendar for the week ahead. The week that was, however, was a pretty strong one for Aussie shares, up 2.6% on the S&P ASX 200, and gains across most sectors. Healthcare down 0.7%, technology down 3.8%, and property trust down about 2%, missing out. Healthcare tends to suffer when the Australian dollar is very strong. We've got our major healthcare stocks like CSL, Cochlear, Ramsay, big overseas earners. So when the Australian dollar is strong and they go to translate their overseas earnings back to Australian dollars, they have fewer Australian dollar profits to report. So that is why they suffered. We saw rising bond yields. We'll see it in a couple of slides at a time. US 10-year bonds, in fact Australian 10-year bonds also rising above 1% for the first time well, certainly since the start of last year, but more recently for the last couple of years haven't been up around that level, and that tends to hurt technology stocks. It tends to be high growth stocks. They have low yields themselves, and when markets start to factor in high interest rates, that does tend to hurt those more growth oriented stocks. Property trusts, no real explanation for why those suffered. They are probably more of those value type stocks, and we look at financials, they did pretty well. Energy did pretty well on the back, very well on the back of a rise in crude oil prices. So we had OPEC Plus had a meeting, and the Saudis agreed to cut their supply to allow some of the other producers to increase, but no net increase apart from the scheduled small increase that they had flagged to the markets. The markets took that as a sign that energy prices under control by OPEC Plus. Consumer discretionary looking pretty good at the moment. We have seen strong retail spending numbers through the Christmas period, and also we've seen a couple of companies come out there with upgraded guidance for the first half, which is encouraging. Material sector, obviously iron ore prices on a tear, as are some of those other industrial metals, and look, the rest did pretty well also. Gold's up about 4%. But we will probably see that reverse today, so we've seen a pretty sharp decline in gold and silver on Friday night. Have a look at how the Australian market is tracking. We have a fairly broad now consolidation patterns. It's been going really since the start of December, late November. We have tested that 65.85 level we can see, which is marked here, and we've had sort of 1, 2, 3 tests and a hold. And I would suggest that there's enough demand down here to solidify this level as a key area of support, and I think that's quite evident in the price action there. And assuming we can get through the supply that is clearly in the system here, and how do I know this supply? Well, we've had 3 attempts to get through this sort of 67.50, 67.70 level, and we've been beaten back, and we are having a look at it today, but unfortunately today a slightly softer session, so it probably won't happen today. But I think if we do get above that 67.76, we are looking quite constructive, is the word I'm searching for a move into the old highs there around about 71.97. So a nice consolidation zone through here. Could see a breakout. And when we start to measure targets, you look at the move into the consolidation zone, and then you can project that out. So we could even break through those highs, and if we get a similar timed move, that chart is fairly predictive, isn't it? Could be sort of late January, early to mid-February that move completes itself. But hey, that is prognostication, so we will monitor closely and see what actually happens. In terms of what happened around the world, we have strong gains through Asia, so anywhere between sort of 2 and 3% there for the Nikkei, the Shanghai Composite, and the Hang Seng. The Nikkei at its best levels since the early 90s, and the Shanghai Composite best level in, I'm going to say, 3 or 4 years. And the Hang Seng, I haven't looked at that chart actually, but also doing very well. I do know for certain that we have record highs in the US, certainly on the S&P 500, that closed at a record high, up 1.8% for the week, and the Nasdaq up 2.4% was also a record high. Good to see volatility coming down as well. FTSE had a huge week, a bit of catch up perhaps because the DAX is clearly at a record high. France is getting close to one as well, so maybe just the UK catching up a little there. Aluminium, copper, lead, nickel, steel, big jump, 11%. Tin, zinc, all higher on the London Metals Exchange, some of them quite nicely. Nickel up nearly 6% also. Copper up nearly 5% in New York. That is a very strong gain. Iron ore now trading around about $170 a tonne. Most of our big miners, Fortescue, BHP, Rio, they are pretty lean and mean. They have cash costs of around $20, $25 a tonne all in. So they are making super profits around here. And we did see a pullback towards the end of the week in some of those precious metals. I mentioned gold and silver in particular, but we had some weaker economic data in the US, and in combination with those rising bond yields, that is not good for your precious metals. They don't have a yield in comparison, so when there are more attractive yields in the market compared to gold and silver, who yield nothing at all, that is problematic. And typically gold and silver are held as a hedge against inflation, and we had some poor economic data, and that's typically deflationary. Have a look at some of the other commodity markets up the top there. Crude oil, huge week, 8.6%. I mentioned why earlier on. Natural gas also did well. Australian dollar, with the strength in those commodities, performing nicely, up 0.7%. Actually got through 78 cents at one stage during the week. The US dollar index rallied right at the end of the week. But interesting to see the Aussie dollar so strong, given the US dollar index actually rose slightly, and we can see these rising bond yields here. So 12 basis points on the 10-year Australian bond, but 20 basis points on the US 10s. And when we think when the Federal Reserve, the Australian Reserve Bank of Australia, come out and announce an interest rate cut or increase, often it's by about 25 basis points. That's a fairly typical one. So you have seen the market place a 20 basis point increase on rates in the US, and that is largely to do with the Biden administration coming in. They're making lots of noises about the extra stimulus they're going to provide to the US economy in the order of magnitude of trillions that they're talking about. They're talking about increasing the handouts. It was $600 that was approved by Donald Trump and the Republicans more recently, but the Democrats want to see another $1,400 go out to take to $2,000. And if you're earning less than $75,000 in the US, every man, woman, and child gets one of those checks. So a family of four, mum and dad, and 2 kids, a typical nuclear family, would end up getting in total $8,000 of free money from the US government to go out and spend, and it will no doubt have a positive impact on the US economy, and that's why we're seeing knock-on effects come through to shares. In terms of how we're tracking this crisis against the last, and hey, we might even have another line. If we come back and tune into this in however many years, there'll probably be another line on the chart for the next crisis and how it tracked against this one and the last one. But uncanny, isn't it? Uncanny how similar the markets have recovered this time compared to last time. That's just a little bit of fun, and we keep looking at that on a week-to-week basis. We're also looking at the COVID cases. I did mention this is the US one here. What happened here, obviously things were going horribly over there. We were starting to get a bit of a dip. Then we had the Thanksgiving holiday. Americans, they don't like to be told what to do, so they all got together, gave each other COVID, and we saw the huge spike. We were starting to come down, and then we saw the Christmas New Year period here, where everybody got together, gave each other COVID again, and we've seen another catastrophic spike in cases. Markets are looking past this anyway, so let's look past this because markets are looking to the other side and they're looking to stimulus, they're looking to vaccines, and they're looking to increase earnings down the track. Maybe I'm being a little bit facetious, maybe a bit silly, because this still is the single biggest risk to global stock markets at this point in time. If that situation gets worse, if we see some bad news on vaccine rollouts, if we see bad news on vaccine effectiveness, the stock market will react, and it will react severely. So we do need to keep an eye on that situation. Having a look at some of the economic data out during the week, we saw the ANZ job ads come out a little bit lower than the previous reading there in December, so 9.2% gain. Still a gain, it's still a fairly robust one. We can see lots of green bars here, so that's very good. And the height of these green bars far exceeds anything we saw in what we call more normal times pre-COVID. So that's very encouraging, I think, for the Australian economy, even though that 9.2 is a little bit down from the 13.9% in November. And if you added all these bars up, we've probably taken out the destructive impact of those two bars there when COVID was at its worst. Also doing reasonably well, we've got a small increase here in building approvals. Interestingly, the houses, so standalone houses, did very well, up 6.1%, units up 2.6%. When you average out all of the numbers, we get a 2.6% gain. It's a little bit less than the 3.8% we had in the previous month, but roughly in line with the expectations. So we'll take both of those bits of data as fairly positive, or indicating a fairly positive start for the new year here in Australia. We've got a reasonably strong start for China. Look, they've done really well. They've done really well, to be fair, and this manufacturing PMI of 53, which was a little bit lower than the previous one of 54.9, but it still indicates growth. So anything over 53 still indicates growth in the sector, but it was less than markets were expecting. But a little bit of cooling off, perhaps. A bit of a rest before hopefully some stronger performances in the Chinese economy to come later in this year. I can't see any reason why that wouldn't occur. On the non-manufacturing side, on the services side, we saw 56.3 come in. Again, a little bit down from expectations, but still showing a high level of growth at the moment in the Chinese economy. But on watch, I would suggest, given that we've seen a 1 month, and it is just a 1 month because they're all trending higher before that 1 month, little bit of softness there. Okay, having a look to the corresponding data in the USA, these were actually very good. So we look at 60.7 there on the manufacturing purchasing managing index, and it was way ahead of expectations and up from the previous month. And that is still indicating a V-shaped recovery, which is curious. It's encouraging, but also curious considering some of the other data that we got during the week. On the services side, now services have lagged a little bit, but that was still a very good print, 57.2, up from 55.9, and well ahead of expectations. And we say services tend to lag because of the impact of coronavirus. It's harder to potentially go and get a haircut if you are in lockdown at the moment, as some regions within the US are. The big data from during the week, no doubt the US non-farm payrolls. This is our employment data, and it tends to be the biggest data release of the month. Markets watch it very closely. We saw 140,000 jobs lost in the US economy for the month of December. And that was worse than the expectation there for a jobs creation of 88,000, so way off the mark. I would say that maybe the headline's a little bit worse than the reality, because this number in November was actually revised up by just under 100,000. So net, I would say not as bad as this number suggests, but still not. Look, let's cut the rhetoric and just look at the trend, isn't it? And that's what I like about charts, and that's what I like about being able to just simply look at a trend. The trend is not good. So whatever you thought about the actual number itself, clearly the trend in jobs creation, jobs growth within the US is not fantastic. And that is why the Democrats certainly are talking up the need for further stimulus. So you've got, and that's what I mentioned before, those PMIs in the US were a little bit curious given how poorly some of these numbers are looking here. Okay, let's keep moving. No broker moves, as I said, so we'll go straight to the value insights, and we're comparing the Australian market and its price to earnings ratio, so how much on average companies are going to earn within the ASX 200 compared to the price that we're paying for them. You're looking at about 19.86 times earnings, which is better than the rest of the world, who's at about 20.85, but still very high. So we typically consider once we get to sort of 20 and over, we're basically expensive. When we're around 15, we're fairly well valued, and then anything sort of under 15 towards 10 starts to get very, very cheap. So we are definitely at the top of the valuation range, but if there's any consolation, it is that we are looking less overvalued perhaps than some of the rest of the world. Drilling down within the sectors, where can we find value? The materials sector has had a fantastic run, but because earnings within that sector are expected to increase, the price rises are quite justified, because the price to earnings ratio, the ratio of the price increases to the earnings increases, are about the same, and we've seen that this sort of maintain around 13, and it still looks to be the best value sector out there. Looking at some of the other sectors, next best value would be the financials stocks, and their PEs haven't risen all that much, and the prices have been fairly stagnant over the last few weeks, so maybe go look into that sector for some value. I do note we've added, we're looking to add Suncorp to our list of technical buys this week, but we do have existing buys on ANZ, CBA, Australian Financial Group, ticker code AFG, and Resimac, ticker code RMC as well in that space. Looking to the next best sector is property trust here. So I know we do have buys on GMG, and we've got buys testing my memory on Lifestyle Communities. LIC is the ticker code on that one. And we'll summarise the rest, because I'm not going to be able to remember all of our buy notes. There are many dozens of them at the moment. Most expensive would be the technology. There it is there. So we can see that we have had some price increases, but they have not been matched by increases in expected earnings, because the PE ratio has risen. Have a look at the market from a technical perspective, and what we're investigating here is the number of companies within the ASX 300 who are trading above their respective moving averages. So we've got a 5-period moving average. You think about 5 periods on a chart. We don't include weekends, so that's 1 week. That is 1 week on the good old chart, and out to 252 periods, which is about 1 year. So you take out all the public holidays and all the weekends, is about 252 trading periods in a year. And we're starting to get more sort of long term over this side, and we're starting to be quite short term over this side, and somewhere in between is perhaps a little bit more medium term. So we have about 70%, so over 2/3 of the stocks in the ASX 200 trading above their sort of medium to long-term moving averages, which is very, very encouraging. So that tells me that there is demand in the market coming in and turning these trends around. In the short term, a little bit less, probably closer to 50%, but still encouraging. We are going through a bit of a consolidation pattern at the moment on the chart. A breakout would see this shoot up to join the longer-term averages. It's worth comparing these rather than looking at absolute numbers, and we compare to the best of the best, which is this green line here. That was the all-time high for the ASX 200 when we were at 71.97. So we can see we're actually better than that in many respects, and that is very encouraging for further gains for our market. And we've got only a little bit of leeway to make up here on the short-term averages. So that is as good as it has ever been for the Australian market, and we are better than that in some regards right now. Having a look at where we were a week ago, and that's simply because the market ebbs around in that short term. We are improving there. That's good to see, and about where we were a month ago also. And well off the lows. So down here is as bad as it gets, the March 20 COVID-induced lows. So we're certainly looking very strong there. Have a look at the week ahead for Australia. Very quiet week. I haven't seen them yet. As soon as I finish this, I guarantee I will go off and have a look at what the retail sales data was. Obviously preparing for this, I haven't had a chance. And that's pretty much it for the week. So if you're an economic data watcher, put up your feet, and you've got the rest of the week off. For Australia at least, because there's plenty of stuff going on in the global economy. So under my head here is a picture of the whole world. So we've got the global economy going there, and we are getting Chinese inflation data today with this consumer price index and the producer price index coming out very shortly. Some data there for Europe this evening. I'm trying to just pick out the key ones here, the important ones. Nothing major there heading into Thursday. Here's some pretty big ones. 2021 has kicked off with the big theme being inflation expectations and rising inflation expectations. We've seen inflation expectations reach about just over 2% over the last week or so. So I don't think we're going to see a whole lot of inflation this year. That's my big tip. I think the market's got it wrong, and I think the data is going to show us that. So we'll be watching some of this inflation data very closely. Pretty quiet through there. Chinese money supply, I do like to look at that. And then weekly unemployment claims. First speech this year from Jerome Powell, the Federal Reserve Chairman. Retail sales for the US, definitely a big one, definitely worth watching. Core PPI, which is the producer price index, another inflation measure in the USA. And then the University of Michigan consumer sentiment and inflation's expectations. And that wraps it up, I think, for us today. You can catch all of our market news updates right there at the thinkmarkets.com/au/market-news. You can follow me or the Think Markets handles on Twitter if you like. We do have some other webinars coming up. We'll have one on Wednesday, 3 sectors to watch in 2021. And I'll talk about some stocks within those sectors that you might wish to buy as well. The Wednesday after that, we've got the Ask the Experts session where you get to ask me about the stocks you're interested in. I'll give you a quick fundamental and a technical on those. And the week after, we will do a Think Learning on Introduction to Technical Analysis. And I'll give you a great grounding in how to read those charts. The disclaimer before I leave you today says that everything we've discussed is general in nature. Please read the disclaimer carefully. If you have any other questions, give us a call or consult the website for details. Don't forget we are a registered Australian broker, and some of our products could see you lose more than your deposit. Other than that, it's been a pleasure joining you today. Hopefully you got lots out of it, and I will catch you very soon. All the best for your trading. Until then, bye-bye for now.